Investment committee
Hey.
webinars.
Oh yeah. All right. Let's get into
All
it.
right. So, welcome guys again to another investment committee. This is where we like to just give a little bit of an update in terms of where markets have been, give you some of the news that's been going on and why or how it might be impactful to you or not impactful. And then today we have a special guest, Frank Pina. We're really excited to get into the weeds with him. I don't know why there's a question mark over his head. It's he actually has all the answers, so maybe that's why. But let's shoot over to market update.
All right. So I wanted to
So
give you guys an update of how the market looked in 2024. Coming off a really strong year in the market, the S&P was up about 25%. And if we look at some of these major indices and how they performed in 2024, you can tell that domestic large cap growth companies were really the place to be for last year. So the Nasdaq up about 26, S&P up about 25. If you look at some of those other major indices, the Dow Jones, which is focused on blue chip stocks, only up about 15. The Russell 2000, which is focused on small cap stocks, up about 12%. And the international total stock index really lagged up about 5%. So the S&P and the Nasdaq were really dominant in terms of the performance that we saw in the market in 2024.
Yeah, and looking at just at the year to date really quick, I mean, we're only a couple weeks into the year, but we've seen some volatility in the market, but the S&P and the rest of the indices up around 2%, and then international being up around 1% for the first couple of weeks of the year. So we're starting to, I mean, you could say continue that positive momentum, but we're kind of gonna have to wait and see to how certain things will play out and come to fruition, as the year continues.
Yep. And looking at the 10-year Treasury rate, right now we're at about 4.62%. If we look at the start of 2024, it was around 3.85. So it actually increased significantly in 2024. And that's due to a few reasons. I think looking at the start of 2024, there were a lot of rate cuts that were expected. And throughout 2024, the expectation of growth in the economy really increased. So the GDP in the US was quite strong at about 3% per quarter. Inflation stayed pretty stubborn at about 2.7, 2.8%. And so for a lot of reasons, there's less rate cuts expected moving forward, which is the reason that we've seen this 10-year Treasury rate actually drift up over 2024. One other thing to note, Bitcoin in 2024 was up about 117%. A lot of this gain was seen after the election due to the expectation of less regulation around cryptocurrency and some more support from the president on cryptocurrency. And that's continued year to date, up about 13%. What else have we seen, Brandon, in terms of like sector performance in 2024 and since that election?
Yeah, I mean, I think it's important to look at, the S&P 500 and the other, major indices, but then also taking a little bit deeper dive into, certain sectors and what's kind of, driving that in a sense. You can see in 2024, consumer discretionary and, financials were kind of leading the way in that sense. And since the election, so for about 2 months now, a little bit longer, you can really see that momentum following through with consumer discretionary being up 13 and financials being up 8. Something interesting to look at with consumer discretionary are, the top two holdings of it, which are Amazon and Tesla, which have really been, driving that, force to be up that much. And then, some other sectors where it might have underperformed or negative since the election, consumer staples and real estate. Consumer staples being a little bit more defensive in nature. And then, real estate still seeing some side effects from interest rates, and then also, inflation concern too for, those sectors. But I think it's important to, highlight not only what's going on generally in the market, but also a little more detail of, what's outperforming, what's underperformed, and kind of take notice of that as well.
Well, I think when we also talk about the market, right, the one thing that is going to be extremely predictable over the next 12 months is that nothing is going to be predictable. And it's interesting that you bring up, Tesla and Amazon, which are, two of the, the tech CEOs that were, that attended the inauguration. And there's been a lot of conversation around a lot of different hot topics that will impact GDP, will impact the economy, will impact the direction of the United States of America during the campaigning cycle. And what we can take from the last 4 years of Donald Trump's presidency is that, there is a lot that he is willing to get out and say. And then it's just a matter of how much actually makes its way through, how much of it gains steam, how much fizzles out. But there will constantly be talk around it. So if ever a time to not be an oracle, this is the time to be just really observative and understanding that when certain things in the market zig, what is going to zag, and vice versa. So while we look at these numbers and we say, interesting numbers since the election, I think we also have to come to the realization that there will be some turbulence in different aspects of your investing, whether it be Bitcoin, the Treasury, the S&P 500. So let's see what unfolds. I think we just need to be patient and watch and be ready.
We just had Jordan join us as well, so he's on the panel now.
What's up, guys? Sorry for being a little late.
No problem. So getting into some of the news stories that we've seen over the last month or two on rising inflation and potentially less rate cuts. So looking at CPI, which is an inflation gauge over the last 3 months, the average reading of that has been 2.7%. The 3 months prior to that, the average was 2.6%. So inflation is actually inching a little bit higher, and it is a bit above that 2% long-term target that the Federal Reserve has for inflation. So with that, mixed with the potential for tariffs on the horizon, Trump has been mentioning potentially a 25% tariff on Mexico and Canada starting on February 1st. We still don't know what the evolution of the campaign trail. It's going to be different seeing how those actually get enacted and how they evolve over time. And you can see 56% of the market, if we look 4 months out to May, thinks that rates will be in the exact same spot. So I think that just points to there's a lot of confidence that there's going to be a cut. Could we see a rate hike potentially? I think it really depends on the data that we're seeing in terms of tariffs, inflation. It's going to be interesting to look at that.
Well, and the conversation's evolving a little bit around the tariffs. It's it's how it's going to be measured in terms of which countries it's going to go against. How much they're buying from us versus how much we're buying from them. There is a lot of politicking that will be happening behind that. That news title. So again, another thing to just kind of say, how do you predict it? You really can't.
Yeah. And even with, the changing news of what's going to happen with rate cuts, no rate cuts, the potential rate hike, that kind of all being in the news week to week. You can still see over the last couple of weeks, the S&P is, up 2%. So even with the conflicting kind of news stories, you could say, that are kind of in your face, you're still seeing, the S&P be up at 2%. So
Point, Brandon. It's a good point.
All right. So another news story we've been seeing over the last month or so, a new market mania, quantum computing. So a lot of you might have the question, what is quantum computing? So I looked it up. It's an advanced computing that can run calculations a lot faster than traditional computing. And it can potentially solve like very complex problems. So it's just a very advanced version of traditional computing. It's kind of the next level. And if we look over the last month, there's been a lot of quantum computing companies such as like IonQ, Rigetti Computing, D-Wave Quantum that have had these really big run-ups in their stock price over the last 2 months. And if we really look at these companies, none of them are generating significant revenue. They're all still in that developmental stage and they're not profitable at this point. And NVIDIA.
So Sean, do you know what temperature you need to have these systems at in order to keep them running and at the speed that they run?
I do not. Do you?
It's negative 457.67 degrees Fahrenheit, or absolute zero.
Oh my goodness.
So part of also why quantum computing is 20 years off. Just the ability to run one of these computers it requires a ton of energy.
Well, just to not take up too much time here, because I think as we're talking about quantum computing and what's going on, as Bobby just mentioned, there's a lot of challenges. Not only does it have to be down to absolute zero or absolute Kelvin for those chemistry majors in the room, it also has to not be disturbed at all. So there have been issues with quantum computers trying to operate and not working because of airplanes flying above. So you have to have a very stable system to make these things operate, but it's really a solution without a problem. The problem, the reason it got a lot of news, Google's Willow, which is one of their quantum computers, which has 157 qubits operating at once, that solved a math problem which was unsolvable before. Good for them. It's a math problem. It's not, an actual real problem like cancer or something else. That's what caused the real excitement. It showed that technology was moving forward. Jensen Huang comes out on NVIDIA's at a conference talking about NVIDIA and their new chips, and basically says it's 15, maybe 20 years before quantum computing can actually be applicable. Stocks went up 1,000% on the news from Google, went down 50% on the news from Jensen Huang. So there's a lot of volatility here. There's a long time period. I think one thing is when GameStop was all the rage and people were asking why GameStop's up 1,000%, it's very easy for us as professionals to kind of see like, hey, there's a lot of excitement here that doesn't have a lot of fundamental basis. And I think that's what Sean was kind of pointing at. Like, the companies don't make money. They are absolutely nowhere near making money. They could have some great angel come in and start giving them a government contract or something. Elon Musk commented on the Willow discovery with great enthusiasm, and given his proximity to the White House, that maybe could go somewhere. And I think that was kind of part of the catch-up. None of it's wrong per se, but it's extremely speculative. And I think when we get calls and conversations about this stuff, we don't know any better than anyone else really what's going on. We can objectively see the companies don't make money, and I think everyone can objectively see that. We're not like sleuths figuring it out. But I think the question is, how much do you bet on things like this? Do you take a jump at it? Do you maybe temper your excitement and wait for, the headlines to kind of cool down? Do you have time for that? And I think that is a little bit more as we're going to go through these things, Bitcoin and, XRP and all these other, coins that rallied off of Trump's announcement around his win. That mania that sparked is something that, we get a lot of questions around. I'm glad people are asking questions. And I hope people continue to ask questions, but we should be ready for more of this stuff. This is like, it's kind of a Instagram investor world these days where people, it's on Reddit, it gets caught on fire, it gets distributed much faster than it used to, with taxi cab drivers in New York giving hot stock tips in the early tech bubble. Now it's kind of democratized across the internet. And so as you see these things, we encourage people to reach out and ask.
A lot of the sound bites that are coming across over Instagram, you also have to realize it's not really Elon Musk. It's AI generated voice over Elon Musk. So, even when you start to see some of these sound bites, it's good to ask the questions, to Jordan's point. It's good to, it's good to take that extra step.
And even like you, Bobby, we were joking around yesterday. Someone was giving advice about how to put real estate in a trust and get a step up. And we were like, that's the exact opposite. So it's just, there's a lot of stuff I think people are seeing online. There's a lot of misinformation, just like.
Oh, I did actually comment on that post, and I told him he can check all financial information by us beforehand, and I gave him an email. So
yeah, so I think the main thing is just letting people know, like, there's a lot of stuff that's going to go out there. Price movement can make things very exciting, but it's always good to just kind of give a gut check and have a conversation before you get fully committed on the next big thing.
Well, and I was saying to Sean, technology has moved so quickly since COVID, and our just the way we've adopted it into our lives because we were forced to evolve into a new way of doing things, doesn't mean that the entire wave of technology is going to catch on that quickly or process that quickly. So I think sometimes people get a little bit ahead of their skis. They get so excited and they get, these new opportunities, and we've seen such a wave of positive returns over the past couple of years, and a little bit of FOMO, and people don't want to miss out on the next opportunity. And I think that just because you don't want to miss out on an opportunity, it doesn't mean that we don't vet things out and we don't look at things in a more methodical way. So let's when you have those questions, let's deep dive. Let's really go through what are some of the opportunities or concerns, so that this way, when you're making an education, it's not on FOMO. I'm sorry, if you're making a decision, it's not on FOMO. We're actually having an educated conversation around this, so this way we can weigh out the pros and the cons.
Yeah. Awesome. So looking at the S&P 500, some statistics on declines, we have a video that we want to share with you guys, a quick snippet. It's about a minute long. So I'm just going to pull this up, get through this ad real quick.
I think it's exactly on the minute.
Yeah.
Yep.
You should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. But once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 50 in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine. You're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of it. They're going to happen. No one knows when they're going to happen. It'll be people tell you about it after the fact that they predicted it, but they predicted it. Right.
Love it. Love me some Peter Lynch.
So Sean, do you want to explain who Peter Lynch is for the crowd?
Peter Lynch is one of the grandfathers of investing. He ran the Magellan Fund for about 20 years, which was a mutual fund that had extremely good returns over a 20-year period. He's also known as like the father of GARP, which is growth at a reasonable price. So he's very well known in the investment community.
Yeah. So one of the big things with Peter is he was a very common sense investor. He was like buy what you know kind of guy. So if you shop at Walmart, maybe you want to take a look at Walmart and invest in their stock. I think a lot of investors who have found themselves in the Mag 7, who are retail investors, probably use the same idea, right? I have an iPhone, I should buy Apple. I shop on Amazon, I should buy Amazon. I search on Google, I should buy Google. And that hasn't been a bad playbook. But I think the important thing he was talking about there was using declines as opportunities. And this was just something we found. This is from Capital American Funds. They have our Capital Group is their parent company. They have this thing. I don't necessarily agree with the average length and frequency, but this is the data they came up with 1954 to 2023. And it's about, coming up with how often does a 5% decline? How much often does a 10% decline? How often does a 15 or 20% decline? How often do they happen? Using the same math that Peter Lynch was saying, like we take this many years, how many times it happened, divide A by B, and you end up with about once every year. I think the statistics I've been used to growing up has been a 10% decline happens once every year. and a 20% decline happens once every 2 years. So this is extending out those timeframes based on using 1954 to 2023 versus I've always looked at as 1920 to 2010. So the statistics are moving in a positive direction as far as how often you have to endure these. But I think the main thing is you have to endure these things. Like, this is part of the game of investing. And there is a way to build that into your strategy as opposed to feel like you need to immunize yourself from it. There's a way to actually say, I can benefit from this knowledge. I can move forward going from good outcome to exceptional outcome, to steal Peter Lynch's phrases. And I think as we look at the start of this year, a lot of people are concerned what's going to happen. Markets had a really strong 2 years. What if it falls? And I always turn that around. I say, no, it will fall. It's not a what if, it's a when. So knowing that,
Well, and
how do you want to
it's
play?
the same. It's the same concerns that people had in 2016, right? The market roared for the next 4 years. People thought that the market was gonna tank. I
Well,
think
I don't even think it's politically motivated. I think it's just it's could be a concern you have if the market just dropped 10%. Could be a concern you have if the market rallies 10%.
I see it that way just because we're aligned right now with the inauguration. So most people's heads are around the political atmosphere, and I think that right, politically or not politically, because it won't be political in the next 6 months, but right now it just kind of is because that's the environment we're in. You're dead on. You're spot on. And that's that's when you have to be nimble.
Yeah. So I think though that we always try to help people think about, like, start assuming that's going to happen. Like, we're gonna have a turnover. There's gonna be a fumble. What are we gonna do when it happens? And having a game plan so we don't just sit there and yell at the ref about someone did something on the play. It's
Or take the assumption you close your eyes and sleep for the next year and then wake up. That also isn't the best of strategies either.
Yeah, the old Warren Buffett, knock yourself out for 10 years and then wake up and just so yeah.
I mean, it's better than sell and wait on the sidelines, but it's not the best strategy.
No, it's true. Yeah, but I think there's also opportunities to benefit from it. And if we just kind of walk in eyes wide open, this is gonna happen. It's in the future. So let's build the plan for it when it happens. And it doesn't necessarily mean we just have to sit in cash. There's sometimes a better mix of things. And so we always encourage people, let's not run away from the problem. Let's not just say, oh, great year, like, let's move on. I think that's all nice, but we do need to always kind of say what happens when the going gets tough, because
and it's different for different people.
No, for sure.
Another
But
thing
I'm
that
sure
you say, Jordan, as well, is like the length of these cycles seems to be shortening and truncating as the market has kind of developed and technology has developed. Like, you look at COVID in 2020, it hit its low in March. By May, it was already at all-time highs. So it seems like these windows of opportunity are shrinking at times because of just how advanced the market and technology has gotten. So
well,
really
also don't underestimate government response. Government response tends to be there's a small smolder, pull out a full fire truck plus helicopter hose. Yeah. So that is also, I think, caused a little bit of, and companies have more versatility, like you were saying. It's very easy. It's hard for an industrial company to drop its capex to zero. It's really easy for Meta to just fire half of its employees. So it's a little bit of a difference of, like you said, the companies that are leading the way just have more flexibility in their business models.
Any last remarks before we kick it off to the main event?
I mean, I think Peter Lynch gave a great example there of, you're looking at something and it was $14 and now it's $6. Does it still make sense? And if it's a good quality company that you kind of believe in, that's a good buying opportunity. Is that always the case in certain declines? No, but in certain senses, it's a good opportunity to capitalize on, kind of what Jordan was saying earlier.
Yep. All right, let's move.
All right, I think Michael Buffer needs to come out. It's time to bring out the contender. All right, Frank's become a friend of the firm. We really enjoy our relationship with him and thought he'd be great to just come on and give some of his perspective. He's the managing director over at Mercadien Group, and they are certified public accountants. Frank, why don't you give a little bit of your background, and then let's kind of hop into the heat of it, because I think they'd rather hear you talk about you than me talk about you.
You got it. I never miss opportunities to run my mouth, and this is a good one. So thanks for the opportunity to be here. Appreciate the education you gave me leading up to my little spiel here. So thanks for having me join early. The whole Rocky Balboa thing still cracks me up. At one point, I was this scrappy blue-collar kid from South Philly, but now with this raspy voice, I sound more like Mickey Goldmill, Rocky's trainer, than Rocky himself. So I don't know how much longer that nickname's going to stick, but I'll take it for as long.
That's because you spend too much time doing testifying as an expert. You have to start yelling out your facts and figures, and
That's right.
takes away from the voice, right?
That's it. But so it's funny. Like, so I got into forensic accounting when it really wasn't forensic accounting. You know, back in the early 2000s, financial irregularities was the term. You guys probably remember Enron and WorldCom, and there was all this financial malfeasance going on in the marketplace. And I had an opportunity right out of college to enter into this business. I was trained by former federal prosecutors and federal law enforcement agents who had retired in that capacity and then joined accounting firms to start what was called forensic accounting and dispute consulting services. I always found myself to have like a unique blend of school smarts and street smarts. So trying to think like a crook, trying to figure out the who, what, where, when, and how of the situation was something I was kind of good at growing up. I liked puzzles, and I was pretty good at numbers. So unlike most of my counterparts, I jumped right into forensic accounting and investigative consulting when most people went into audit or tax or some other form of traditional accounting. I enjoyed doing that, and I realized that, you know, taking an investigative approach and combining that with analytical skills to uncover financial crimes or help parties in dispute resolve financial issues was just something I got good at over time and tried to embrace that in a major way. I started my career at Deloitte, which at the time I think was certainly a Big Four accounting firm, might have been the largest in the world at the time. And about 12 years ago, I met Mercadien and decided that, you know, the global work was great and the international travel was great. But at that time, I was, you know, a young dad and wanted to kind of build a business at an existing firm who worked more regionally. And I got to sleep in my own bed a little more often, doing a lot of interesting things in New Jersey, Pennsylvania, and New York, because unfortunately, there's a lot of forensic accounting needs going around.
So what do you see? What do you see the biggest?
Go ahead.
What do you see the biggest needs are when people call for you for your services? Where do the talk to us a little bit about those opportunities that clients would be giving you a buzz, looking for you.
Yeah, so I keep reminding myself, and I encourage business owners to kind of remember that although, you know, we like to think people are going to wake up every day and do the right thing, at any given point in time, there's going to be a certain percentage of the population that's up to no good, right? So when I get called, it's usually not in a good situation. A company is now recently been made aware that there's allegations of employee dishonesty going on, and that probably has an economic impact to them. Or they're being sued, or they're in the process of suing a vendor over a contractual dispute. So my role is really to, depending upon the nature of what I'm engaged, is to work with the attorney representing the company or the client to help them manage that business controversy. So my practice is kind of split into two general areas. One is corporate investigations, where you're essentially helping assist organizations, whether they're publicly traded, for-profit, government agencies, or nonprofits, try to investigate allegations of wrongdoing, try and determine whether there's any merit to those claims, figure out who did it, why they did it, what essentially the economic damage of the organization was, how to help them recover it, and then what can they do to put remedial actions in place to help them from preventing this from happening ever again. So that's sort of where I spend half of my time. The other half of my
What do you find, before you jump in the other half, what do you find to be the most apparent targets when you go into this, when you get into the books and you start to really uncover or peel back some of the layers of the onion, what are the more frequent things that you see or find yourself uncovering?
It's that trusted employee who's been with the organization a long time, who business owners tend to mistake trust for an internal control. And that employee is given a lot of leeway to do things, sometimes on behalf of the company, sometimes on behalf of the individual owners, and something goes awry in their life. So there's a pressure or an opportunity. A lot of times what we see is if it's a trusted employee, there's a new medical issue that they now have to deal with, or there's a spouse loses a job, there's a drug addiction or a gambling addiction that now causes financial difficulty. And this once very trusted employee has to find means to pay for these things in a way that they can get their hands on quickly. And oftentimes their biggest piggy bank is their employer. So a lot of what I'm doing now is getting calls from employers or in-house counsel or law firms who represent these employers saying, we think one of our trusted employees concocted a scheme and took money out of our business, whether it's theft of an asset or financial misappropriation that ultimately benefits themselves.
Listen, we've even seen a family member, an in-law family member, who siphoned off over $1 million in a 10 to 12 year time frame. I mean, it's not just an employee; it could be family.
Well, Bobby, I'll share why I got into this business. Is an interesting question. I was a victim of identity theft at the hands of somebody in my family while I was in college. While I was living away at college, somebody in my family thought it was okay to use my social security number and just apply for a bunch of credit cards, knowing back then that, we didn't have the internet access that we do today. All the mail was going to my primary residence, which was where my parents lived. And I wasn't getting mail at my dorm room at Drexel University. So I find that, it's often those closest to you who have the most ability to hurt you. And, that was one of those situations where I was kind of conducting an investigation in my own right, trying to unwind what happened in my own life. And then I had an opportunity to hook up with these folks at Deloitte to really learn how to go about doing it full time. So you're absolutely right. It's that trusted employee, it's that family member. And, I keep coming back to that saying, trust but verify. Trust is not an internal control. One of the things I would leave the business owners on this call with are, just do what you can to put protective measures in place so that you don't find yourself on the wrong end of that decision. Simply put, don't let the person who opens the mail also deposit the checks and reconcile the bank statements. Put some separation between those tasks so that you kind of limit the temptation and also limit the opportunity.
So you're saying that's where you spend half of your time. What about the other half of the time?
So the other half of my time is what I'll call litigation support services. So normally it's party A is suing party B over some economic damage, whether it's a contractual dispute. We entered into agreement, party A didn't deliver on said agreement, and therefore there's a damage. In those situations, I'll typically get retained by counsel representing either the plaintiff or the defendant to either put forth an affirmative economic damage, sort of what happened as a result of the alleged inappropriate actions and activities of the other party, or I'll work on the other side as a rebuttal expert to kind of critique and evaluate the affirmative expert's evaluation of the situation and try to arrive at a situation where the parties can settle, which I think is probably the most favorable outcome. It is very expensive, as you can imagine. If things don't settle and you go to trial, a lot of the winners are the accountants and the attorneys and not the parties in dispute. So
give an example of you don't have to give a client or a specific specific case that you worked on, but an example of where that would pop up for the people who are listening, so they can get a little bit of a picture of that.
Yeah, so it could be something as simple as a landlord-tenant dispute where there's a commercial lease and one party decides for one reason or another, maybe it's financial difficulties, I can no longer afford to pay my rental obligations under this lease, and therefore there's a default, And depending upon what's written in that lease and the provisions and how tight or favorable it is to one side or the other, there's a calculation as to what that tenant might owe that landlord as a result of the default. In a more complex situation, it could be something along the lines of seller sells a business to buyer. There's a post-closing process that takes place 30 or 60 days after closing. And, there's a situation that involves a recalculation of what working capital might be after the buyer takes possession of the business. And there's a dispute over that because there's an earnout attributable to that back end side of the process. So a lot of these situations, sometimes they're gray areas in that one contract provision could be interpreted multiple ways. Trying to figure out the best way to interpret the contract might not always be the forensic accountant's job, because we're not attorneys and we shouldn't pretend to be. So we don't want to perform legal services, but we're often guided by what attorneys who retain us to perform services around sort of the position they ask us to take. Sometimes, for example, they'll say, assume party A is liable, which is not something that a forensic accounting professional will ever opine on. That's up to a trier of fact, like a judge or a jury. But they'll say, assume there's liability here. If they are in fact liable, based on what you've seen in the paperwork and in the interviews you've conducted, what's the economic damage calculation look like? So again, a lot of times we issue these reports. The reports bring people to the table. Both parties see that maybe they don't have the greatest of cases, and they agree to disagree and reach a practical settlement, which kind of puts this behind them so they can focus on the forward. Other times there's a lot of emotion that goes into these litigations, or there's already a ton of money spent fighting, that there's really no choice but to see it all the way through and go to trial. And that's where you'll see experts like me testify either at depositions or in court. And I've seen it both ways. I've seen the law and order aspects where it's very professional, and I've seen courtrooms that are very theatrical, like the My Cousin Vinny. So, I tend to play well in both of those situations, but it does depend on the jurisdiction you're in, sort of the nature of the claims and the court in which the claims are being brought.
So on a contentious side, are your books in line, or is somebody maybe dipping into the pot when they shouldn't be? Or if there's something in a transaction or an agreement between two parties, there's a dispute and some sort of a resolution, monetary resolution that you help your clients you help your clients come to.
Well, it's interesting you say help my clients. So it's funny. I'm engaged.
Help the parties that are related, because the attorneys are your clients.
Well, so it's funny. This is the distinction that, like, I'll get crucified on the stand if I don't make on this call, on this recording. An expert calls balls and strikes. They might be retained by one side versus another, but I don't advocate for my client. I advocate for my opinion, right? So it's important to know that, because although typically one party is paying my bill, I'm not an advocate for that party. I'm calling balls and strikes based on where the evidence takes me. And my opinion is what matters in that situation. And sometimes the opinion may not favor the client, in which case the client has a decision to make. Do you want to put my testimony on the stand if essentially I make the other party's case? It doesn't always happen. There's always kind of two sides to every story. I think because the internet has a long memory, I want to just be clear that I advocate for my opinion and not for my client, because that's what an independent expert's job is.
So you're obviously getting deep into the books of businesses. You have obviously a rich understanding of accounting practices. This is on the dispute side. I'm assuming that your firm has capabilities that go even on a productive side. From the sense of helping business owners with their accounting needs, helping with maybe valuations or putting deals together. Do you guys cover the gamut, or do you strictly hang in this one key area?
No, I would say we're about 150 or so employees. We've been around 60 years. We have 2 offices. We are what I'll call a super regional firm, although we have certain practices that are international in nature and national in nature. But for the benefit of, I think, your audience, we're dealing mostly with privately held business owners and maybe high net worth individuals. So we run the gamut. We have a high net worth individual practice that caters towards the complex tax needs of those folks. We have an M&A practice that helps sellers prepare for and then sell their businesses and go through that auction process or evaluate an unsolicited offer if it seems to make sense. We also do a lot of buy-side due diligence, which is helping existing clients make accretive purchases to position them for growth in the future. One of the other practices that we see a lot of growth in right now is in the outsourced CFO and outsourced accounting group, where we'll step into the role of a CFO on a fractional basis to allow business owners to kind of work on the business instead of so deeply in the business. It just gives them that high level strategy or that soup to nuts bookkeeping controller level service that they're missing or having a hard time hiring for. In some cases, we get retained for project work with the goal of hiring ourselves out of a job. So we kind of run the gamut. I've been doing forensic investigative and litigation work probably for the better part of 20 plus years, but through your network and through your learnings, you do a variety of different things. I just had a client call me to talk about some tax planning and relocating to Florida from Pennsylvania. And in the background, I noticed in her Zooms that she had what looked like some really cool Andy Warhol paintings on her wall. I thought maybe they were knockoffs. Turns out they weren't. Turns out that they were sitting on her wall in Florida uninsured. And I said, maybe it's time we look to do something with those paintings if they're not bringing you joy and they're uninsured and you live in a hurricane zone, right? So it's one of those things. And we took her through that process. We got them appraised. We put them in an auction in New York City, ended up getting significantly more for them in auction than they appraised for. You can imagine she was very happy with that. And now she had newfound funds to do some things she might not have otherwise had an opportunity to do. All through a conversation around what it takes to relocate to Florida. So
right. Sometimes it takes that, jack of all trades mentality along with the expertise that you have to really bring a true breadth of valuable advice to clients, right?
Yeah, and I think the goal is
you have to know more than just your lane. You got to know when to bring in other people, like an auctioneer.
That's right. And I can tell you, I try to make 1 and 1 11 instead of 2. Because at the end of the day, you get further if you bring in the right team, and you really shouldn't be
Jordan,
doing.
we're gonna have to steal that because we usually say 1 and 1 equaling 3. I like 1 and 1 making 11.
Well, here's your visual. 1 and 1 is 11, right?
All right, well, that's why I'm gonna steal it.
There you go. I actually stole that from my partner Myron Geltman, so I got to give credit where credit's due. But and that's my point. You learn from working with other people, right? You learn from bringing in the right team, and we continue to grow. We are certainly open for business. It's interesting. There's been a ton of consolidation in the accounting industry with private equity making purchases and acquisitions and larger organizations acquiring smaller firms, maybe because they don't have succession plans or maybe because they want to take on a pocket of business in a geography they're not playing in today. My firm made a concerted effort to stay independent. We're making the investments in technology and the people so that we could try to be a real solid player for those underserved, lower to middle market privately owned businesses that just may not need to pay those higher rates working with the larger institutions.
Well, and that's one of the things that we shared in conversation was we're in a similar spot in our industry where there's a lot of consolidation. These private equity firms need to put money to work and they're aggregating up these firms. And what do you lose? You lose your personal touch. You lose your ability to be, creative advisors, to have conversations that you can bring other individual professionals in to help, cover the gamut of all the needs of the client. So, we understand that wholeheartedly because we're dealing with the same stuff. But you know what? When you're in a space like that, you have the opportunity to get over, get some of those clients that look at their existing relationships and they go, you know what, this isn't what it used to be. I need my new breath of fresh air. And sounds like you guys are set up to be that new breath of fresh air.
Well, that's the hope. And I think it all comes down to people and developing the right relationships and always showing up, responding with a sense of urgency, and just understand you're dealing with people's lives here, right? Like if you think about it, the impact you make on the engagement they hire you to perform will likely have a real solid impact on what happens to them tomorrow. So I think you have to I come back to, books and records don't commit fraud, people commit fraud. So it's about, understanding the human dynamic and getting in the minds of the people that you're working for or working with or investigating even. But it does all come down to that human element. And I think you and your team demonstrate day in and day out, having personally made referrals to you guys. I always know that when I make that referral, those folks are in good hands.
One of the things that you brought up was, which I find interesting, and I'm not sure if other people on this call would find interesting, but I believe they would, is the fractional CFO, because I think a lot of companies, they run without a CFO. And really, that's the heart in the decision making as you start to look at maybe there's a strategic acquisition or a new, new line that you want to go down in your business. How do you really put the numbers against it and match it with the strategy? What do you find are the most often asks for people who come in and they say, you know what, we need to bring you guys in as a fractional CFO and the value you can bring?
Well, so it happens a lot when it comes time to a business owner thinking about readying the business for sale. They might have a CFO in place, but that CFO might not be a deal guy or girl, right? Because it's very difficult to maintain a business and also, market yourself for sale. So in a situation where the business owner,
I love you, Tom, but you're not a wartime consigliere, is what you're trying to say.
right, make an offer somebody can't refuse. But in that situation, we fill that role really well. We're not looking to take the CFO out of their day-to-day. We're looking to bolt on a deal mentality so that we can maintain the data room, help with the sell side due diligence, the quality of earnings, respond to all those buyer due diligence requests. That becomes a huge distraction for a business owner if they don't have a CFO, and and also it creates, in my opinion, you leave some money on the table. Give you a quick story where we were approached by a fast-growing home healthcare company that didn't have a traditional CFO. They caught lightning in a bottle. They were marketing geniuses. They fell into an industry that was really hot, but they were getting unsolicited offers by a lot of people. They didn't necessarily know what to do with them, but they all look really good. So I remember convincing one of my clients not to take a $150 million offer. And they're like, what? And I said, well, look, I'm just saying, based on my research, the EBITDA multiples are significantly higher. You really should take this through an auction environment, hire an investment banker, and we can help you do that. Fast forward like 11 months after they declined that offer, they ended up selling that same business to the same private equity firm that approached them originally for significantly more. And at the end of the day, they attribute some of that increase in value to what we were able to help them accomplish. They acquired.
Yeah, I mean, even if the increase in value isn't that much of a multiplied effect, you still have the beauty of allowing the existing CFO or whoever's sitting in that seat to continue the operations of the business while you're ready for sale, because that's a whole new beast of itself in terms of, keeping the business running while also prepping it.
Right. And while you're going through that process, there's also that sort of estate planning conversation that goes on. Okay, we're selling the business, but how do we figure out how to keep as much of those proceeds in our own pocket instead of having to give it up, right? And I'm sure you get involved with those conversations with your client. And that's why it's important that the right team is involved with those situations. So the attorney, the wealth manager, the accountant. And I just find that for those people, they say the best time to plan to sell your business was 5 years ago. The next best time is today. We can try to help clients in that outsourced CFO role basically understand that spending a couple dollars on this service is going to pay dividends. It's going to help you sleep at night, and it's going to get you across the finish line in a more expeditious way.
Right, because 1 + 1 = 11.
For now, right? Until I come up with a new one, I'll start using that one.
Let's use it. I mean, I love it. Listen, we're coming up at the 45-minute mark. We actually just passed it. Just want to leave with some parting remarks. Is there anything else that you want to kind of add to this before we part ways and send off your information, so this way, if people are interested in having a conversation offline, they could do so?
I guess I'll just leave everybody with the notion that if you're ever in a situation where you're dealing with employee dishonesty or fraud allegations, or find yourself with a Department of Justice subpoena, don't panic. There's sometimes the government gets it wrong. Sometimes the opportunity it's a blessing in disguise because you might have identified something today that hurts a little bit, but could hurt a lot more in the future. But just make sure that you have good legal counsel, you have a good accountant, you have a good wealth manager, and that you have a team around you that cares about what it is you want to do and where you want to go. And to me, having that team is worth its weight in gold. So I'll just leave people with that.
All right, Frank, listen, all of Frank's information is going to be in the notes. If you have any questions, he's been gracious enough to say he will take it offline and field any calls that you guys have. Listen, appreciate your time. Investment committee, we're in January, new presidency, new year, new markets, quantum computing, starting tomorrow. Everything's going to change. It's going to be amazing. Jordan, you have anything you want to leave the world with?
I just want to thank Frank for coming on. It's always great to hear, some good stories, some good third-party stories. I'm going to go check all my paintings in my house to see if any of them are Warhols. But thanks to everyone for coming on. Obviously, 2025, we're hoping to be a really good, positive year for markets and for everyone's business, and anything we can do to further that. That's why we do this. That's what gets us up in the morning.
And remember,
Here, everybody, thanks for the opportunity.
no better time than now. All right.
Carpe diem.
Appreciate you guys.
See you guys.
Cheers.